Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra, with me Shel Bhatnagar, and this is the Diwali special edition where we are going to be making you meet the topmost voices of the stock markets in India, and also to help you really understand what is really going on with the markets and what should your approach be in this continuous fall in the markets, which reports are already indicating could be the worst Diwali in last 10 years that we are seeing for the bulls, because the markets are just not stopping in this correction. But let's find out if there is a way out from these top market masters. Let's welcome on the show. We have Mr. Maneesh Dangi, the CEO and founder of Mosaic Asset Management, Mr. Mihir Vora, Chief Investment Officer of Trust Mutual Funds, joining in, and we also have with us Mr. Nischal Maheshwari, our market expert of the day as well. Warm welcome to all three of you, and thank you so much for taking the time out. Here's wishing all of you a brilliant Diwali ahead and an even better year to follow as well. Even though the markets are missing that festive cheer that we are used to of, but probably we should be looking at this as the best time that one should be really looking at to buy into these markets. Let me start off this discussion with you, Mihir, and understand from you, is this the correction that everybody was waiting for is finally here? Is a major part of it already done, or is there much more to go from here on? What is your sense?
Hi Sakshi, first of all, season's greetings, happy Diwali. Wish you all the best for the coming year, and especially good luck on your investing and your portfolios. See Sakshi, I don't know. I don't know whether the glass is half full or half empty, but I definitely think it's half full. Diwali till date, last Diwali till date, we are up about 24% on the Nifty.
Yes.
We are up 35% on the small cap index. So why are you being so greedy? Markets corrected like 7, 8, 9%, and we are already talking about doomsday and all that. But let's look at the perspective from where we are coming. At one point in time, of course, the markets were up say 30%, and now they are up 27%, 24%. I'd take that outcome any year, frankly.
Right. Good afternoon, ladies and gentlemen. A very warm welcome. We are very fortunate to have all three of our guests as great value pickers, and they take very good delight in buying market which is corrected smartly. Manish, this is a question for you. Is this time to sort of change allocations within portfolios towards debt? You've been advocating corporate debt for quite a while. What do you think is the great way ahead over the next 12 to 24 months in terms of a change in the type of investments retailers can make? Manish, this question was for you. Do you see a change in asset allocation benefiting retailers over the next 12 to 24 months with more emphasis on debt?
Yeah, I'm sorry, I couldn't hear your question earlier, but I guess you're asking about asset allocation incrementally.
I think we have a sound issue with Manish. We'll try and get that fixed, but let's get Nischal ji into the conversation. Nischal bhai, you've been one of the most well-known value pickers in a market, and this correction is of course God sent. What do you think should be the allocation of fresh capital from current levels over the next 12 to 24 months?
Morning. Sorry. It's afternoon for you basically. So afternoon everybody, and season's greeting to all your viewers. I think incrementally allocation as far as fresh capital is concerned, I think one should be a bit cautious in the market. I do agree with you, basically some amount of debt should be looked at, given that interest rate cut is likely to happen. It's already started in the US. And it's going to come through in India also, maybe in the current quarter itself, basically, and in December you're going to see rate cut starts happening in Indian markets also. So one can play that trying to buy long dated securities basically, or invest into funds basically which are long dated, holding long dated securities. So some debt allocation should be there. At the moment, I would say basically a 50-50 kind of a situation, maybe 50% debt, 50% equity is a good sum basically to invest into the market at the moment.
Okay. Mr. Dangi, can you hear me? If you can,
I
then
can.
could you tell us that in this downturn in the markets, how should an average retail investor really take the maximum benefit to really look at the long term and see this as probably in hindsight that we will talk as the best opportunity to get into the markets?
No, I'm assuming that an average investor, and I hope you can hear me.
Yes.
An average investor has been doing, dollar cost averaging SIP, he must continue. I mean, there's no point reacting to markets if the underlying thesis itself is that you'll average it out. That's for the very large audience of ours. And to the ones who actually want to time market, I guess, we discussed a month ago that we were on a cliff and 8-10% been knocked off since then. And I guess another 8-10% ahead. So it's a good news. There's more money to be invested than what it's invested right now, and therefore it's a good news for this Diwali that you'll get an opportunity maybe next 3-6 months to dial up risk on equities. My sense is that Indian macro is evolving in a fashion that will take some zing off markets, not just because of the valuations priciness that we have in India, but also at margin, cyclical slowdown is underway and a pretty deep one now. So that sort of may pave way for an opportunity at some point in time in terms of markets available at cheaper than where they are right now.
Right. Mihir, this one is for you. Shall this side. This is your second fund which has just been launched by Trust AMC in the small cap space. Given the markets ahead, where do you think is maximum value to be had as far as retail investors are concerned? What should be the fresh allocation of capital within equity? How much towards large cap, mid cap and small cap?
Sure, Shell. It's actually a dream time for us because we're just closing the fund today, and all the monies that are being collected are all in cash. So you absolutely have the luxury of picking and choosing stocks as we build the portfolio in the next few weeks. So that's good. But the thing is that we are still positive on the Indian economy compared to the rest of the world. So while there are some indications of some parameters slowing down, but the fact is that even if we slow down to say 6% or 6.5% GDP growth rate, we will still be amongst the fastest growing economies in the world. So that's that status of India in the relative scheme of things should continue. So within that construct, I'm still positive on the domestics. For example, the banks have not performed for almost 2 years, and with good reasons. And hopefully with the worst of the tightening behind us and us going into a interest rate cut cycle, I think next 1 year could be a good time for the banks, especially banks who have not stretched themselves by going in for too much of unsecured lending or microfinance lending, which is where some of the stress pockets are. So I think most of the large Indian banks fall into that category. Things are pretty hunky-dory. They're not leveraged. There's ample capital, and margins should start improving. So large banks and large NBFCs should have a good time in the coming year because valuations have now really time corrected for 2 years. So that's one big pocket. And second is that theme that we keep talking about, which is all the physical asset creation themes. If India is to grow at 7%, we just cannot do without real estate, infrastructure, manufacturing, investments. And that, I think, will continue to remain the focus of the government. Of course, these sectors had become too popular, and we are seeing the correction in valuations on that. But the long-term theme in these segments does really continue. So any correction, I would really love to buy in these stocks.
Okay. Mr. Maheshwari, let me get you in. From this somewhat to the next somewhat, where do you think outperformance in the markets will come in from? Are there any 2 or 3 sectors that you believe have not performed which will now take the front row, and that is where the allocation should go in? If you could also add any key stocks that you are now going to be going big on till the next somewhat.
So I think one of the areas which I think should do well is basically that is the interest rate cut, which has already started happening in the US, and all the sectors which are going to be positively impacted. So if you look at it, basically, I think from India point of view, IT is going to be one sector. So if the interest rate cut starts happening in the US and majority of your customers are in the US and the spends start happening, which is likely to happen if you look at it, all the large cap IT companies have really said that the order books are good and they are seeing some green shoots. So I think IT is one space basically one should be invested in, and maybe now time to go overweight on IT. So IT both big and small cap, but obviously I prefer the mid caps because obviously the growth rates are going to be better in the mid caps. The second space which I like, and I think Mihir has said it very clear, very right, that government capex. I think that's going to be another big theme. The last two quarters, because of the elections, uncertainty and all, I think there was a slowdown very clearly. And I think that is going to go behind behind us. So there, I think the government capex is another major theme which is going to emerge. So I think cement is one basically which I like as a sector. The worst results are being given in the current quarter, but I think going ahead, next 2 quarters are going to be really good, both in terms of prices as well as volumes. So cement is going to do really well. Again, power, if you look at it, especially on the new policy which has been declared by the government and likely to come through the NEP, there is going to be a huge demand on the T&D side. So these are 3 or 4 sectors basically from this Samvat to next Samvat one can play. I very clearly see that there is going to be a real strong demand in these sectors.
Right. Nischal ji, you've given us very good leads in the power and T&D space. What is your view now on the defense space and the railway space after they've corrected substantially? Do the investment thesis in these 2 segments remain in place after this 30-35% correction in prices, or is this a sector which is best forgotten?
No, I don't think so. This sector has really emerged very well. If you remember our last conversation also, I told basically there is a lot of frothiness and these sectors need to correct. And I think they have done so. There maybe now what we need to do is basically go out and see that is the correction enough. In some of these spaces I see, some of these stocks I see, there has been good correction which has happened. And there is strong order books for most of the defense companies. So as a sector, I think this theme is playing out in the next 1 decade. I don't have any doubt about that. The only thing is basically the stocks that run away quite a bit basically and need to be corrected. I think some of these stocks definitely both on the railway side as well as on the defense side are really good stocks to pick. But let's go stock by stock, look at saying that basically the earnings are going to be strong and comparatively valuations are reasonable. I think that's the way. So yes, very good sector. If some people have got trapped at the higher end, wait out for it, because I think patience is the only thing basically which makes money in the market.
Kya baat hai?
Okay, wonderful. Mihir, let me just get you into the conversation as well. Tell me, what is the biggest learning for investors in this downturn in the markets? Have you also, as a fund manager, regretted anything in the run-up to Diwali this time around? Maybe not adding enough gold or diamonds or silver in your portfolio as you would have had. How would you really look at the past year gone by?
I mean, frankly, again, Sakshi, I don't see any reason to complain about last year because the Samvat has been very good. In fact,
yeah.
1 year ago, I don't think any of us were predicting that the Nifty would be up by 25% and the small cap index would be up by 30-35%. So I'm just grateful that we have done the way we have. Obviously, going forward, expectations we need to temper down because we've had a stellar run since 2020-21. So obviously the kind of 25-30% compounding that we have earned in the last 4-5 years are not going to be replicated in the next 4-5 years. So I think the reset has to be within ourselves mentally rather than in the market, because markets are doing their own thing, right? They are facing earnings, they are following the corporate fundamentals, and we as fund managers and investors should continue to do what we do, which is basically buy stocks where you see growth and avoid the pockets where there is turbulence. So I think as long as we have a normal market where we are talking about long-term growth rates of 10 to 12% for the large cap indices and maybe a little more for the small and mid cap indices, I think we should be fine. Beyond that, whatever alpha you need to create, you should do by stock picking. On the asset allocation side, I think you touched upon gold, and of course, as a mutual fund, as a flexi cap fund, which is the one we have, we obviously can't buy commodities. But I personally, at a personal level, I am also bullish on gold. The thesis being that the US and the Western world economies have no choice but to print their way out of the debt crisis that they are having. So I think they'll have to keep printing, and precious metals, real estate, emerging markets, everybody will get money at the cost of the Western currencies.
Right. I hope Mrs. Vora is watching this segment. Otherwise, we will cut this space and send it to her, Mihir. And this is something probably you might regret saying on air, but nonetheless. But amongst all of us, it is Maneesh who's best positioned to answer this gold-silver conundrum. Maneesh, till about 2 months ago, there was this slogan in the market: 1 lakh on the Sensex, 1 lakh on silver, and 1 lakh on gold. So silver is off the mark and is reached there. What do you think is driving gold to these, if I may use the word, absurd levels? The Indian housewife has beaten everybody hollow over the last 1 year. She's up 50% and all of us are still finding reason to exist. What is your view on gold from current levels, and what should be the sectoral allocation for this one?
So the reason why gold, and I mean all metals of course, but gold more specifically is being driven up is not necessarily for the monetary policy reasons. Typically what happens is that the low real rates in US drive gold higher. But what's happening right now is typical micro reason, which is demand supply, demand from China and Russia more specifically, but in general, the sovereign demand after good 1.5 decade of slowdown has re-emerged. Incrementally, especially after what happened to Russian reserves, lots of countries have sort of decided to reallocate their foreign reserves to gold, and which is why that demand driver is back. So a very large part of gold rally is more to do with supply being where it's been, but demand at margin, about 2-3% extra demand has sort of emerged from central bankers. Now, would this continue? This has now become a proxy of China exports. So if China continues to export well and accumulate a lot of reserves, it would sort of at margin drive more gold demand. I don't think India at margin is an incrementally big player. We've always bought a lot of gold, about 1,000 odd tons. But the delta shift has actually happened to China and its demand. It could very well be, as many argue, that a new world order that we're looking at, where de-dollarization is underway, and until we sort of fix the alternate currency, BRICS, INR, CNY, whatnot, gold is a place where lots of foreign central banks will sort of move to. Now, if that's the trade that you want to play incrementally at margin, be my guest. But this is not an asset allocation trade.
Okay, fair point. Mihir, before we let you go, there is this talk in the market that rural demand and both urban demand seems to be contracting, and something that I'm hearing for the first time, the Indian middle class is contracting. I mean, for 30 years we've not heard that, and one of the biggest cornerstones of this bull run and of course the growth in India is the burgeoning middle class. How do you react to these statements when they come from the corporate boardrooms of Nestle and Hindustan Unilever? Is this really a pain in the market? How do you see it?
Sure. So I think the jury is still out on this one. The problems seem to be happening because we have this new trend, especially in the urban market, the large urban markets, of the quick service delivery model is really, and the online model really taking away market share rapidly from the traditional retailers. So I think the stress that the distributors of the traditional FMCG companies, the traditional distributors are facing probably is a bit more exaggerated because of this. And moreover, what's also happening is because of the proliferation of online brands, the traditional brands, especially the multinationals and the well-established brands, are facing problems at the higher level. Because, for example, if you go to the social media, Instagram, etc., there are lots more niche segments available in the premium categories, which are much better in quality at more reasonable prices, and people are going out there and buying. So this is an urban phenomenon. I don't believe in the demographic, reversal of what we have seen over many years. These are mega trends that income levels will continue to rise, purchasing power will continue to rise. That those trends don't change in a hurry. So I think we should wait it out for the next couple of quarters and look at the aggregate of what's happening in the quick delivery space and the traditional and the non-traditional suppliers of FMCG and all those materials.
Let me get Mr. Maheshwari also into the conversation now to ask you about, sir, the mid and the small cap space. Mid caps are now 10% down from their record highs. They were entered the correction zone now. Do you think the frothiness that we were talking about or the valuation heating that we were talking about a few months ago and all the mutual funds and the industry at large stalled certain bulk money that was coming towards these spaces is now done and dusted? Can one still look at this space right now, or is there much more to go?
So yes and no, basically. I think there is enough places out there. I don't see any reason for being pessimistic about the mid cap and small caps. I think there is enough stocks out there which are showing 30-40% kind of growth in the earnings. And if they are commanding a 30-40 PE, I'm saying that's a fair number basically. 1 PEG is a good number basically to generally look at. You will typically invest into less than 1 PEG and try and see if it can go to 1 PEG and higher to that. So I'm saying there is enough. So what you need to look at is basically is how's the earnings and what is the kind of outlook basically which these companies have. I was telling you a few of these areas earlier, and each of these areas basically when you listen to their calls, there are stocks in the power sector basically which are talking about 70-80% kind of growth, and they are talking about next 3-4 years of order books. So one has to be just careful about it. Yes, the frothiness in some of these stocks which had run away. I think one of the sectors which you had highlighted earlier in case of both railway as well as this thing. So some of exuberance do happens in this market time and again, and market obviously pushes back and brings sense to the market. So this is what is happening in the current market, but there are enough opportunities. So don't get disheartened. I think it's a good market, and money, I think, keeps on coming basically. Mihir will be able to obviously tell us his new fund is just getting closed. There is enough money which is coming into the mid and small caps.
Okay.
Absolutely. I think it will take a lot of while. It will take a lot of while to our retailers to get off the small cap and the mid cap mania. But nevertheless, Nischalji, what is your view on these mega IPOs and QIPs that in hindsight now seem to have spoilt the party? They've always done that in the last 20-30 years. But new investors learn it a little later. Do you think that was the trigger for the sell-off, or it was a combination of a lot of other things, excessive valuations, and God knows what else? What do you think caused this present sell-off?
So there have been several factors basically. Yes, one of them is basically at the higher end. Obviously, everybody wants to cash out. And several of these mega IPOs, if you remember 20-30 years back, each of these one large IPO has been at the top of this market basically, and markets have corrected. But I think one major thing which had happened is basically China started doing well, and it was available very cheap. And the FI started pulling money out and going ahead and investing into China. So I think that has been one of the major reasons where you have seen this kind of, I think in October, if my numbers are right, 10 billion has already got pulled out.
Yes.
So I think that's a very large number. This kind of number we've only seen in, I think, COVID time, in one of these months, basically, where they pulled out around $9.5 billion.
Yes.
So I think $10 billion is a very large number. But if you look at it in the context of today's Indian market, it's not very large. But when it gets done in a month, I think it starts impacting. Secondly, obviously, valuations, we were all very cautious. All the market experts have been cautious for the last 3-6 months. We have seen a huge amount of exuberance on the SME market, which was another game altogether. So I think these are excesses in all, in history, we have seen these kind of excesses happening, and it gets corrected. So nothing to worry about. I'm saying the biggest positive which I see for the Indian market is the equity culture. I'm saying SIPs 25,000 crores every month. I think that is the biggest change which we have seen. I think, and that is not changing in a hurry. So that is the biggest thing, basically, which the positive message which we have for the markets. I'm not seeing any big crashes happening in the stock markets.
Okay. Let me get Mr. Dangi also to add on to that. 2 points right there. One on the FII sell-off, the biggest ever sell-off in history that we have seen thus far. And secondly, the way DIIs, mutual fund investors, have been supporting the markets, and they have clearly been the market movers this time around. One, will the FII sell-off continue at the same pace the way it has been going on? How long will this sell-off continue? By when does it become a concern? And second, how long do you think DIIs will continue to have the strength to support the markets going forward from here?
So FI trend, of course, as the previous guest said, one part of it is, of course, China. The other part is the Trump trade, which basically is sort of lifted rates, tightened dollar again. And so to that extent, the reversal of 2024, where US dollar was weakening, and therefore at margin incrementally a lot of capital was moving to emerging markets and also India, of course. So both a relative price of China, along with, of course, a potential recovery there driven by stimulus, has led to money moving out, but also alongside, of course, the macro trade also has reversed. So would this end by, typically with, news in, these things tend to end. So perhaps at the Trump election or after the election, this should end. So it's not too long before it's sort of this manic selling will stop. Perhaps it will stop very quickly. On the DI side, this is with awe that everyone keeps looking at, that, India has built these great pipes. By the way, India has had, big equity culture in 90s and 2000s also, but then most money would come from HNI pockets, and some of it was a bit of a mis-selling driven by ULIPs. These pipes are actually, which is sort of taking MFs and many other vehicles to small cities, and bringing 1,000, 2,000, 5,000, 10,000 rupees. They are solid pipes, and perhaps would continue for very, very long. It's also driven by demographics, emergent middle class in India, and folks who are rich enough to deploy 5,000-10,000 rupees, 20,000 rupees monthly in equity. So all of that perhaps is more fundamental and structural in nature than what it was in 90s and 2000s. So that's a good news.
Right. And amongst the five of us, the guy who's very smartly not smiling is Mihir. He's the happiest because the trend that Maneesh talks about is reflecting very well on the assets that he manages at Trust AMC. Maneesh, my final question to you. Who is coming in the US, Kamala Harris or Donald Trump? And any one of them who comes, who will be better for India?
I mean, no one knows who is coming. US markets, political markets are too competitive and too narrative driven. And as someone wrote that if your fund manager is telling you who would win and betting accordingly, is actually likely fooling you, or he fool himself. So I wouldn't hazard a guess on who is coming. In medium term, so for the global risk, Trump is bad, okay? Because it paves way for tighter rates and stronger dollar. So that's bad for global risk. But as an Indian national, I would like Trump to be there because, Kamala, as such, Democrats tend to be somewhat, I mean, they no, not against India, but somewhat neutral to negative India. Republicans tend to sort of look at India more favorably. So I would sense that and the Modi-Trump chemistry is sort of far better than I could imagine Kamala Trump Kamala Modi chemistry. So I would wish that Trump returns. In near term, of course, it's going to lead to risk off. Some of it is also, of course, playing out in US bonds. Rates have risen from 360 on 10-year US to 4-quarter, and it's along with a little bit of a growth spurt. It's mostly a Trump trade playing out. Dollar has actually recovered significantly again, so it's a bit of a risk-off trade if Trump returns, but good for India.
Right. I would have imagined that the BJP with its Lotus and Miss Harris with Kamala would have made a great picture, but then such is life. Let us see who returns. Mihir, before we let you go, my final question to you. What do you think has been your biggest learning in Diwali to Diwali over the last 12 months, and how do you intend to sort of put that into action at Trust AMC?
Sure. So the biggest learning this year, frankly, has been that if you continued to believe in the India story, you have created wealth. You can choose to stay out of it, but that will be at your own risk. And the second is, ultimately, you do have to pay attention to quality and valuation. So as long as your portfolio was, of good quality, and you had bought stocks which did make some sense in terms of valuations, then you were fine. But if you went into stocks without caring about fundamentals and valuations and just on momentum, then you would be in trouble. So I think stick to quality, stick to your convictions, stick to the fundamentals, and you'll be fine. And keep believing in the India story.
Okay, one last word from all of you before we wrap up. And Mihir, to you first. Your Nifty target till next Samvat, and which asset class do you think will outperform?
I think Nifty should be somewhere around 10%. And the broader market should be a little better than that.
Okay, Mr. Maheshwari, let me come to you. Your sense on the Nifty, where do we see that number going to till next Diwali when we have you on board?
It's a very difficult one, but I think given it is corrected, I agree with Mihir. I think something like a 10-12% kind of a rise, given that earnings are also similar kind of a growth we are expecting.
So approximately the same time, the highs that we have already seen.
Yes, yes.
Okay, so it will be a moderate expectation that we should have. Mr. Dangi, to you then.
No, I think that the Nifty would be flat at best, and the path will be sort of first down and then uptake again. Broader market will certainly be negative relative to Nifty. No one knows the absolute numbers, but as the previous guest said, it's extremely difficult to call a Diwali point for any analyst. So very, very difficult. But I would hazard a guess that we are headed lower than higher over next 1 year.
But will we outperform the other asset classes, Mr. Dangi?
I made this point that Indian bonds long bonds will likely do better than Nifty over 3 years. So I kind of stick to that rate.
And that, ladies and gentlemen, you would have got 2 months ago when Mr. Dangi was with us at Market Masters. That was the capital allocation that he was having. Thank you, gentlemen. It's been such a pleasure listening to such wonderful views, and we hope that over the next many months, all three of you join us individually to get into the dynamics of the market. Here's wishing everyone in your office, in your families, the very best of festivities, and may the good times for India continue to roll. Thank you so much for your time, ladies and gentlemen.
Thank you.
Thanks a lot.
Thank you.
All right, and with that, we wrap up this very special edition of Diwali. I hope you have enjoyed the conversation as much as Shell and I have done. But stay tuned, there's a lot more coming up on your screens on Business Today Television, from Diwali conversations to also earnings conversations that will follow. Stay tuned.
have Mr. Guha, MD and CEO of Birla Soft Limited. This is a mid-cap IT company, and the numbers on the top line are fantastic, but it's the profit after tax where you've seen a slip, not only